How do you become sales tax compliant? Getting compliant isn't just about registering in new states moving forward. It often means addressing the past, especially if you should have been collecting sales tax but you did not do so. In this video, we'll walk through the main paths to becoming compliant, including one of the most useful tools available to taxpayers, and that is the Voluntary Disclosure Agreement, also known as a VDA. At a high level, becoming compliant means you've done three things. First, you've identified where you have nexus. Second, you've registered in those states. And third, you filed all historical sales tax returns and paid the associated outstanding liability. If you've been selling into a state where you have nexus without collecting tax, that uncollected tax becomes a liability because this is something you technically owe to the state. And depending on how long you've been selling there, that liability can grow over time. Fortunately, states give businesses a few structured ways to come forward voluntarily and get back on track. This is where voluntary disclosure agreements come into play. A voluntary disclosure agreement, or VDA, is one of the main ways businesses can become compliant in states where you've discovered a past obligation. A VDA is a formal agreement between a business and a state's Department of Revenue. It's essentially you saying this: we realize we should have been registered here earlier. We'd like to come forward, register properly, and pay what's owed. In exchange for voluntarily disclosing that information, the state will waive the penalty portion of your P&I or your penalties and interest. Here's a simple example. Let's say you determine you've had nexus in Georgia for 3 years, but never registered. You estimate that you owe about $12,000 in tax you should have collected from customers. If you just registered and filed those back returns without a disclosure, the state might add penalties of around 25% plus interest, bringing the total closer to $15,000. By completing a VDA, those penalties would typically be waived, leaving you responsible only for the actual tax and interest. That's the main benefit. By voluntarily coming forward, the state rewards you with penalty relief and a clean path toward compliance. But how do VDAs work in practice? While each state's process looks a little different, it generally begins with a VDA application. In some states, that initial submission can even be done anonymously, allowing you to gauge the state's response before disclosing your business name. Once the state accepts your application, you'll finalize the agreement, register properly, and file returns for the specified period. That period, called the look-back period, is how far back you must file and pay. The statute of limitations in each state is usually 3 to 4 years, which allows for a limited look-back period. So even if you've technically had nexus for longer, the VDA caps your exposure to just those recent years. That said, VDAs are powerful tools, but they're not always the right solution for every situation. They can be complex and time-consuming, which is why many businesses hire professionals to handle them. Each state has its own process and timeline, and the paperwork can be significant. They can also be costly, not because of the penalties, those are waived, but because of the professional fees and the back tax and interest you'll still owe. As a general rule, if your liability in a state is relatively low, a full VDA might not make financial sense. If you owe only a few $100s, the cost and effort of the process could outweigh the benefit of penalty relief. And if you're ever in a situation where a firm is recommending VDAs in multiple states across the board, especially if your liability in those states is small, it's worth getting a second opinion. There's more than one way to get compliant, and the right choice often depends on your specific mix of exposure, states, and business activity. So are there any alternatives? Well, another approach is to register directly with historical effective dates and file back returns. The historical effective date is simply the date when you should have started collecting, typically the month or quarter you first established nexus in that state. So if you hired an employee in Illinois in July of 2020, but are just registering now, you'd register with July 2020 as your effective date. Then you'd file returns for each period since that date. Some states allow you to request penalty waivers when filing these historical returns. A penalty waiver is less formal than a VDA, but it can still reduce or remove penalties, depending on the state's discretion and your compliance history. While penalty relief through a waiver is less certain than it is under a VDA, this approach can still be a practical and cost-effective way to resolve minor or straightforward liabilities. So with all of this said, how do you decide which option to use? It depends on your exposure, your timeline, and how many states are involved. If you have significant liability, especially in multiple states or over several years, the VDA route can be the safer and more protective path. This approach limits how far back you have to file, ensures penalty forgiveness, and establishes a formal record of cooperation with the state. But if your exposure is limited, or if you only need to correct a few states with relatively small amounts, registering with historical effective dates may be simpler and faster. It's also worth noting that you don't have to choose just one path for all states. You might complete a VDA in one state where your exposure is large and backdate your registration in another where your liability is small. Each state can be handled independently depending on what makes the most sense for your situation. The key takeaway is that both paths, both VDAs and historical registrations, are legitimate ways to get compliant. The right mix depends on your level of exposure, your administrative bandwidth, and the degree of certainty you want around penalty relief. Getting compliant can feel intimidating, but every state provides a way to come forward voluntarily, whether through a voluntary disclosure agreement, penalty waiver, or backdated registration. Taking proactive steps now will always be easier and cheaper than waiting for an audit. And like I said before, consulting a sales tax professional is always a good route when you're not sure what to do. But how do you properly choose the right sales tax professional for you? Well, there are 3 questions you can ask to help determine this, and for more on that, check out this video. And as always, when you're not sure what to do, always consult with a sales tax professional.